Hello, everybody. Nation Sell Jackson CPA here with another video for you for Financial Literacy Month. Today, we're going to talk about, oh yes, mortgages. All right, so we're going to talk about how you should think about, how much house you should buy and some things like that to consider. Because if you make a mistake with this mortgage, you could be hurting yourself for the long term. Additionally, should you pay off your mortgage? Some tips like that, some things to think about. So stick around, stay tuned. Again, April's Financial Literacy Month. We're going to be right back with some great tips on mortgages and what you should consider when you're thinking about how much of a house to buy and all that great stuff. So stay tuned, subscribe, like, all that great stuff. Back in a second. Alrighty, hello everybody. Welcome back to another episode of our YouTube channel here. So here's what we want to do. Here's what we want to talk about today: mortgages. As you know, April's Financial Literacy Month. We're giving away a couple tax returns, a couple of Amazon gift cards for people who like, subscribe the video, etc., all that good stuff. So definitely go ahead and leave us a comment, subscribe to the channel, like the videos, all that good stuff. And you could be entered into a drawing for every time that you do that during the month of April. Okay, so we got 11 days left, actually 10 days from the date of this recording. Sorry if it's a little bit shorter once it gets posted, but ultimately just a short period of time left to kind of be entered in for those drawings. So, but ultimately what we want to talk about today is mortgages. Okay, so here's what we're going to talk about. I want to explain why you should not want to get too much of a house. So I often come across this, and I even come across this with some of my clients. And it's frustrating to me when I see a client go out there and spend $700,000, $800,000 on a house, when the market that we're in, you can get a really good house for about $300,000 to $400,000. Okay, so they spend about double what it takes really to get a decent house. And the question is, do you really need to spend all that money on that house? Okay. And what are you hurting yourself by doing that? Okay, how much are you hurting yourself financially? That's the key. See, even though you might be able to afford that much house, should you? Okay, and what could you be doing instead? We call this opportunity cost to further your financial freedom, to build generational wealth, and to bridge that wealth gap that we have in this country. That's the ultimate goal of what we're talking about, is how much house should you really go for. Okay, so let's talk about that, and let's look at a couple different calculators to kind of look at some options here. Okay, so here we have a mortgage calculator. Okay, this is mortgagecalculator.org. It's just a free system software that's out there that I selected. I don't have any interest in it or anything like that, so definitely go out and there's plenty of mortgage calculators out there, by the way. You can go and just search on Google, and there's one that pops up for Google as well. So but this is one that will kind of break down a lot of numbers for you, and so that's why I kind of like it. And this kind of just will show you how much you're actually spending on this loan over the life of the loan, assuming you don't even refinance, or you actually stay in the house for the whole time, etc. You don't sell the house, all those sorts of things. Okay, so here's why you don't want to necessarily spend too much money. Okay, so let's assume that you go and get a $300,000 house. Okay, let's assume you do an FHA loan for your down payment, 3.5%. Okay, and let's assume that means that you have a loan that's $289,500. All right, at a 3.8% interest rate. Now, right now, you could get a more favorable rate. I'm just using 3.8% as an example. But, and we can play around with that a little bit and show you the differences. But ultimately, over 30 years, and property taxes, let's say it's $2,400 a year. Your mortgage insurance, because you only put 3.5% down, is 0.5% per month. And your home insurance is $1,000 per year. Okay. So that's what we're going to be doing here, is we're going to look into this and try to figure out what this means. Okay. So your payment is going to be $1,753. And that includes the private mortgage insurance. Okay. Your interest portion of that you're paying over the lifetime of this loan is $196,000. This right here. That is a lot of money. That's almost two-thirds, well, it's almost 2/3 of the initial purchase price is what you're paying in interest over the life of the loan. Okay. So this is a sunk cost. You can get some tax deductions for it, yes. Okay. So there's some benefit that you receive for paying mortgage interest on a residence you live in, but this is essentially a sunk cost if you don't have something else going on with it. So this is a lot of money. If you think about it, this is a lot of money that you could have potentially been putting to, some other uses. So, $300,000 is a modest amount. Okay. Let's assume it's $600,000 is the loan amount. Okay. Now, there's no way you can get a FHA loan for that high of a loan because they have caps. So let's just assume that you actually put the 20% down. So your actual loan is $480,000. So let's assume you go get a $600,000 house, you put 20% down, your loan is 20%. Okay. You have no PMI, there's no mortgage insurance. And let's calculate this. Okay. Your monthly payment, $2,520. Okay. Look at your total interest paid though. $325,000 total interest paid. All right, that's over 2/3 of this loan here. And that's a lot of money. Okay. So you went from $200,000 to paying an extra $125,000 of interest. And you also had to put 20% down. So this is something that you want to consider. Do you really need to go and get that super pricey house, even though you have the money? Okay. Now let's look at the opportunity costs of that. Let's say $125,000. Let's just round it. And let's say $125,000 over the lifetime of this loan. Okay. Let's say we break down that $125,000. There's a couple different ways you can look at this. Let's break down this $125,000 over 30 years. Let's say you put $4,000 per year of that interest, right? And that's not even including the principal you're paying. That's just interest. But let's just use that for the interest. Let's just say 4,000. We're gonna go back to our lovely tool, the compound interest calculator. Okay, and let's assume that we have an initial investment of 4,000. We have a monthly contribution of $333, which is 4,000 divided by 12. Length of time in years is going to be 30 years. Interest rate, let's assume we get a 7% interest rate of return. Notice that interest rate is higher than the interest rate that you're paying on your mortgage. We're going to talk about that a little bit later. And let's just say it compounds monthly, okay? And let's calculate that. I'm sorry, 125,000, excuse me, could have made you an extra $300,000 towards your financial freedom. Think about that. You spent an extra $125,000. And this is a simplified calculation. If we were to actually dig into this and go deeper into it, it'd be a lot worse because you're actually paying more for mortgage interest on the front end than you are on the back end, if you didn't know that. So it would actually be a lot worse if we were to go through and do this in a more detailed manner. But just on this high level approximation, right? We're losing out on $300,000 of additional profit. That's the opportunity cost of taking too much of a home. That's the way I want you to kind of think about this and look at this. All right. All that money that you spent paying on this mortgage for a house that you probably don't need, let's be honest. A lot of people often will go and get too much house. That's all money that you could have been using to save towards retirement, to do this, to do that. Now, the theory could be, hey, yeah, I can go and pay cash for this. Well, that's also an opportunity cost issue. Okay. Why? Because you're tying this up into an asset that basically there's nothing you can really do with it unless you go and borrow against it. It's really the only thing you can do is your mortgage for your house because you need somewhere to live and you got to go borrow against it. Now, what I would say is where this could make sense is if, let's say, instead of 300,000, you go find something that's 400,000, but now you have a renter in there. Let's say it's a duplex, or let's say it has a casita in the backyard, and you decide to rent some of that out. Well, now instead of that just being a cost center, okay, at 400,000, your interest only goes up from 200,000 to 217,000. Okay, now instead of being just a cost center, you got income coming in, and this is a great strategy. Okay, especially for the younger people who want to buy a house but don't want to necessarily incur all the costs. This is a great tool and a great strategy. Excuse me, let me change this a little bit. Go back to the FHA version just to kind of apples to apples. It's actually 60,000. Let me correct that statement previously. And that's assuming that you're in an area where you can actually get an FHA loan that's that high. There are some limits to how much of an FHA loan you can get. But nevertheless, okay, so 260, an extra $60,000 of interest, but I can, over that 30-year time period, if you, let's say you get half the mortgage paid for, let's say $1,000 a month, you have a little casita or you have a duplex, and you're able to get $1,000 per month. Okay, so $1,000 per month times 12 times 30, that's $360,000 of income coming into you. Look at that. Is that more than the interest that you're paying on this loan? Yes, it is. So now instead of just being a cost center, what are you doing? You're turning this into a profit center. Okay. I mean, ideally, you're going to have some interest, you're going to have some stuff that's going to offset that. Yeah. But, at the end of the day, you should be able to profit off of this. Plus, you get to depreciate a portion of your home from a tax perspective. So there's a lot of benefits to using this kind of a strategy. If you, instead of just having a cost center, either I usually recommend one of two things: either buy a really cheap house. Look at Warren Buffett. I think he bought his house several years ago, decades ago, I believe, and he lives in the same house still. Multi-billionaire living in the same house. Reason being, this kind of stuff right here: opportunity costs. All the money that he could have spent to go buy a mansion or whatever, that's all money that he's taken off the table from an investing perspective and a wealth accumulation perspective. And it just doesn't make sense if you really want to bridge the wealth gap and you really want to have financial freedom for your family. If you really want to retire, this is how you can get yourself out of that equation to where you can actually do that. You have to pay yourself first. Hashtag pay yourself first. I've used that before. Let's not forget about that. That's a very important topic. It's very important to think about and consider. Okay. If you do a mortgage that has a renter that's in there, okay, it's okay to pay a little bit more. Go to 350, go to 400,000, whatever the case is for your market. I mean, everything is relative to your market. I'm using some numbers for the Phoenix market, the Arizona market that I'm in, but you have to look at your particular market to see what makes sense. There's some markets where you can get a decent house for $100,000 still, okay, and that's probably more than enough. But maybe you go to 200,000 and you're getting a duplex, or you're getting a property that has a casita in the backyard where you can get some rental income coming in. So there's multiple ways you can do this. Okay. If you really, really want to go super crazy with this hack, they call it a kind of like a mortgage hack or a tax hack or something, whatever you want to call it. Okay. The reason they call it that is because it's a way to kind of turn your house into a cost center into a profit center. But if you really want to go to the nth level with this, you could even start renting out rooms inside of your main house. Now you're being able to write off even more of your house, and you don't even have to worry about itemizing on your taxes. That's, if you didn't know, with the increase of the standard deduction, most taxpayers do not itemize anymore, even if they have a home loan. Okay, because their interest is not high enough to qualify for itemization. Okay, especially if they're married and living in the same house. If you're single, you still might qualify for itemization because you might get over that threshold. But if you're married, most of my married taxpayers that I have come across my desk, they don't actually itemize anymore because the standard deduction is so high, even though they own their own homes. So, but this is a way you can write off your mortgage interest, your taxes, if you have mortgage insurance, homeowners insurance, a lot of the cost of the home, repairs, maintenance. You can write off a lot of this stuff if you are using it for business purposes as a rental, or as some type of a tax hack, essentially. Okay, so something to think about, food for thought. Airbnb it, Renting out long term, just be careful with your particular market. There's certain laws related to Airbnbs now. They don't like them because they're taking away business from hotels. Whoop de doo. I don't care. That's the American dream. That's capitalism. If it works, it works. Follow the rules and regulations. You're still going to make out like a bandit. Even if you have to pay the hotel taxes in your area or whatever it is, you'll still make out like a bandit because, as you can see, I mean, just look at this. I mean, even if you're able to get $1,000 a month on a duplex, now there's some scenarios where you could probably get the majority of your mortgage paid for. Okay. I mean, realistically, and this same thing applies to rental properties, by the way. The same philosophy. Think about that way. As an additional step. So you have your primary residence that you are able to allocate some of that for personal, some for business. Okay. Then you have rental properties where you can do 100% business, write off 100% of those items, but also have this income coming in, have some passive income. Great strategies to build wealth. Having rental properties, using your own residence to rent some of that out. All those things are great tools that are available to you. Highly encourage you to consider this and think about this, especially as you go to buy a new home or you're going to refinance your home or anything of that nature. Just strongly consider to kind of think about this. And also, don't be concerned about paying down your mortgage quickly. Okay. Although there's a lot of interest here, it's still some of the cheapest money that you can find. A 3.5% interest rate, for example, or 3.8% interest rate, excuse me, is still better than the 7% that you're gaining over the lifetime of that investment. Okay. So even though you're paying that in interest, yes, you are. If you were to take some of that money and invest it, it would turn into more money than what you're ultimately paying in the interest. Okay, so that's another thing to kind of consider and think about is should you pay off your mortgage? If you have extra cash flow, should you pay it off? Or should you invest it and accrue more wealth that way and start accumulating things to where you start to get quicker and quicker towards a millionaire? Some of the savviest people, investors, rich people, etc. Some of the savviest people out there that make money hand over fist, they use debt to their advantage. They use cheap debt to go and make more money. Okay, so they'll use that instead of paying off that mortgage, they'll go ahead and just pay that off, over time. But they might find some way to get some income coming in, like I was talking about. But then you also go and use the money that you would have used to pay off your mortgage to go invest. And over the long term, you're going to get yourself more financial freedom. So those are the things I want to talk about today. Mortgage interest, mortgages, how much should you, invest in your home? Again, it's a cost center. Just think about it that way. It's at the end of the day, it's a cost center. Yeah, you can't write off the majority of your home costs. Okay, the only thing you can really write off are the interest and the real estate taxes, mortgage insurance premiums, assuming they continue to extend that in the tax code. But even that write-off is not that much of a benefit. Don't be so concerned with your write-offs from a mortgage perspective because it's not that huge of a benefit. If you think about it, you already get a $24,000 deduction every year. If you're married, $24,800 for 2020. If you're married, every year. Okay, it goes up periodically with inflation. Okay, so you're already getting that massive deduction as it stands. If you're single, it's about $12,400. Okay, so if you're not really exceeding that substantially, like you don't have charitable contributions, your interests, etc., the tax deduction is not really there. And I have a lot of people who are actually upset about that because of the increase in the standard deduction and some of those changes. But the tax deduction is not really there. So it's not really going to give you much of a benefit to have the mortgage interest and the deduction. And even if it was there, it's not that big of a benefit. You always have to take a deduction and apply your tax rate to it. So let's say you have a $10,000 deduction, and your tax rate is 20%. I'm just using an example. Okay, you apply that 20% to that $10,000. Your benefit is only $2,000. So you just spent $10,000 to get a $2,000 benefit, whereas you could have spent that $10,000 and either turned it into some rental income or invested it, and you could have potentially got more benefit than what you got on your taxes over the lifetime. Okay, so just some things to kind of think about, consider. Don't be so concerned with, oh yeah, I'm gonna go $600,000, $800,000 on a home, and write that off. Additionally, by the way, there is a cap on how much mortgage interest you can write off now. I want to say it's $750,000. I apologize, I don't have that figure off the top of my head, but there is a cap on how much how much of a loan you can actually write off now. So if you go much above, I want to say it's $750,000. Don't hold me to that. If you want to know for sure, I'll leave a comment in the video later. Just ask a question. But ultimately, it is something that is very, very important and crucial. So anyways, hope you guys enjoyed today's video. Hopefully you appreciate it. Again, like, subscribe, stay tuned for more good information and all that great stuff. And we will talk to you next time. Bye-bye. Have a good day.